Yeah, what you got for us? Tell me why we continue higher into 6,200 by July 4th. That's my play. You got to have all-time highs for Trump to, he's going to be speaking. It's America. It's all setting up. The story is too easy.
Well, it's also because of the incentive structure in the market right now, where one of our working theses, for those who've been following along here and let me explain, Overtime or Futures Power Hour, has been that after that early April sell-off, to this day, the market, for the most part, professional speculators are still short, and they remain short this entire time. And so as you get towards the end of the quarter, every bit of bad news basically can be shrugged off because you're effectively trying to chase this to paint the tape. So you can justify holding on to your client's money. Mm-hmm. Guys, one of my big theses over the last several years, like kind of an overall philosophy I have about markets, is that you can be right. You can be wrong if everyone else is wrong. So losing money in a bear market's not a big deal. But if you're not making money in a bull market, why would people allow you to trade for them, right? They might as well just invest in SPY. There's no alpha. Mm-hmm. So right now, this is a market where people have to chase because there's been such a big rebound. And we just got through this Iran-Israel or U.S.-Iran ordeal. We're on the other side of it now, what it seems to be like this chapter having been closed for the foreseeable future. A Fed Chair Powell speech or testimony today probably doesn't stand in the way of anything because his tune has not changed whatsoever. And it means people just have to paint the tape for the rest of the quarter. So with a market that's seeing volatility come in, with oil vol crushed, right? And I think that's the key feature here, talking about this event being over. Oil vol has completely collapsed in a manner similar to what it did back in April 24, particularly on April 19th, 2024, and what happened in early October after Israel and Iran were shooting missiles at one another. So story's done. We're going back to that summer float. July's around the corner. July has been green 10 of the past 10 years for stocks. I am not going to be surprised if we hit all-time highs again in the next few weeks.
OVX, oil volatility, well, we were quoting it pre-market. It's now open, so the new print is started. But we went from 75 with implied volatility at the end of last week. Start of this week, we opened in the 60 handle. We're now at 46.96. We're just under 47 for implied volatility in oil futures. That's now lower or just about where we were, before this whole thing happened. So you've had a full round trip, not only in the price of oil, which is back down to 65 and change, 65.50, which is kind of the middle of where it's been trading. Not only have you had that full round trip, but volatility has completely been taken out. It seems all done.
It seems all done, but I think the question is what happens next. More importantly, Mike and I were talking yesterday on Overtime. At what point do you buy oil, right, and start to think about the other direction here? The one-day rate of change yesterday was extreme, of course. We haven't seen a sell-off like that in oil since July 22. But if you go back through time, and unfortunately I couldn't gather the full data series for Let Me Explain, but we will talk about it here on air for Futures Power Hour when we get to the energy section. Cool. It would appear from a cursory review that a sell-off of this nature typically means that you're at the end of the road. And if you have high volatility on the board, playing directionally neutral is something that is highly efficacious. So my own perspective is, yes, oil has come in. I was leaning short deltas over the weekend, which, let me tell you, over the weekend, that was not fun. Obviously, things have panned out differently the past 2 days by holding on, but it was not a fun open on Sunday night. At this point in time, if you look to the one standard deviation moves, you're still getting, $10, $12 on either side of the current price. I think you got to go 45 and 21 out. Just do the typical tasty methodology here and forget about the headlines.
Yeah, I agree with that. I currently have an iron condor that's a little bit wider than I normally go with, but is wrapped around right where we're at, like 63 to 69-ish. I know you're in one too, but if you've been kind of sitting on the sidelines because of all the things that have happened, you've got a little bit of an opportunity now. So I agree with you, Chris. If you've been waiting for the waters to kind of calm a little bit, now is a very interesting time to get into oil iron condor.
Yeah,
or USO if you want to use USO.
Yeah, I mean, if you had the ability to time it perfectly, then you're sitting pretty. But yeah, I've been in this iron condor with short options at 61 and 70 to find risk 1 point wide, and I've been in it for 2 weeks, and it is 15-cent winner right now, but it was a multi-$100 loser a couple days ago. So it just shows you that if this did not happen, this trade would be a $200 winner right now with crude oil right between the strikes. But because implied volatility has expanded, it's completely offset my implied theta decay on the trade, and it's in the perfect spot right now. So still opportunities out there, even with the crush in IV. But yeah, we've come a long way from the top in implied volatility.
Yeah.
I mean, the event's over at this point in time. And I think for oil, ultimately, you go back to where we were prior to this was happening. You know, where were we before this all happened? We're talking about OPEC production hikes. We're talking about sluggish global growth. And oil is sitting at $64 a barrel. So one has to presume maybe there's a little bit of extra risk premium in there because who knows, maybe the ceasefire doesn't hold. Okay. And that's certainly a possibility. But at your 64, 65, you're probably closer to the lows than you are anything else. And if you've been leaning short deltas directionally, that's probably a good place to either cap off your risk on the other side, sell some downside puts, or just get out of the position and reorient to something like a short iron condor. So it hasn't been fun trading it. It's certainly been a better 2 days. But sometimes you just got to jump in the water, right? The whole point is to avoid the news and just stick to your mechanics. And the mechanics say when IVRs are over 100, give yourself enough breathing room. This storm shall pass.
Agreed.
Yep. Difficult to think of anything else there.
Yeah.
Guys, Powell speaking today. It's been some time since we've had any real conversation about
That's too late, Powell, to you, Chris. That's Mr. Too Late.
And I appreciate last night, by the way, because I'm a night owl. I stay awake until like 1 or 2 o'clock every morning. And Trump was out there around 1:15 a.m. Eastern time last night tweeting about Powell. So he's obviously up waiting to see if the ceasefire is implemented. And he's like, by the way, while I'm waiting to see if they shoot missiles at each other, I got some things in my mind. Let me talk about monetary policy.
Yeah.
It's incredible stuff.
Yeah.
As one does at 1:15 in the morning.
The show does not lack its interest. It's always an interesting show with Trump there.
Yeah, and you'd expect that maybe you get some volatility with J Powell taking the stand today, but I mean, 20-point expected move in SPX for the rest of the day, and we just opened 20 minutes ago.
Yeah,
it's kind of wild.
Powell's smashing vol. I mean, vol VIX below 18. This is lows we haven't seen in quite some time.
And where were we in volatility and stocks prior to Iran-Israel? We were in that summer drift. Low volume, low volatility, positive technical setup where you're trading above your 1 week moving average, your 1 month, and you kind of treating that as support with nothing happening during the day. So it's totally possible we go back to that. It doesn't seem congruent with the news environment, but then again, it's all part of the wall of worry. Markets need a good enemy to fight, right? And all this negative narrative out there is, quite frankly, something that bulls could really use. You don't want to have complacency and, have bears say, well, like, what else could go right at this point in time? Being long's not a crowded trade right now. It's pretty hated. But in terms of Powell today, I think we need to contextualize what he's going to say with respect to some of the comments from other Fed officials in recent days. We've heard from folks like Waller and Bowman saying that it could be possible for the Fed to cut rates in July. I would like to point out, I'm not going to accuse any Fed officials of pandering to the President of the United States, but these are 2 Trump appointees on the Federal Reserve Board of Governors. And one might surmise if you're on the Federal Reserve Board of Governors, you would probably be on a short list to be the next Fed chair. And it's been announced that the start of the search for the new Fed chair, well, that's already begun because Powell's going to be leaving in May 26. And quite frankly, I appreciate that they're going to take a long time to find his replacement. This is not something you just do by rolling out of bed or tweeting at about 1:15 in the morning. So this to me, you have these Fed officials who are Trump people. They're the ones who are talking about the cuts. Powell's commentary that's released ahead of his remarks here at the top of the hour, he's not budging. We're not going to get a July cut unless something goes horribly wrong. So if you're an equity market bull, you don't want too dovish of a Powell right now. That's the incentive structure we have here, because if he's changing his tune, it means something is breaking faster than the Fed surmised, and that's your emergency rate cut territory. We as traders, we only like maintenance rate cuts, and right now we're not in that place. So I don't think the market cares about the Fed right now. I think today's going to come and pass. I think the market now is just going to chase.
Is the market going to care about the Trump tweet after Jay Powell takes a stand? Because that has to be a 100% probability that something will come out attacking Powell, assuming Powell's not going to do anything or kind of say anything contrary to what he's been talking about. You gotta think it's gotten a little more aggressive. Trump's rhetoric. There's
no such thing as free money, but were I to go over to say like a website that would allow me to bet on this, I would probably take the yes.
I mean, I would think that that's near a 95% probability or more, probably.
Yeah, if there's a poly market for what Trump says after this, like they're selling dollars for 65 cents, I'll buy those dollars for 65 cents.
I agree, but do you think that has any effect on the markets?
No, I don't think so this is what's so interesting. I think for most market observers, they haven't spent a good deal of time reading the history of the Federal Reserve. And when you read through some of the biographies on the Federal Reserve chairs, even going back to someone like Paul Volcker, okay, and in his autobiography that came out a few years ago, there are explicit conversations that he's having with the White House about monetary policy. I think because of social media today and the way that media coverage has evolved, these conversations are a little bit more public. Mm-hmm. And as a point of reference to this, why did Iran move all of their enriched uranium out of Fordo before we bombed it over the weekend? It's because they said that Trump was signaling that we were going to do this. So everything is very public now these days. Yeah. But in the Reagan administration, right, Secretary of State James Baker calls Paul Volcker into the White House right before the election and basically reams him out like, you've got to cut rates. And he's like, you can't tell me what to do. That's not your job. And he walks out. And Clinton leans on Greenspan. And Obama has meetings with Bernanke. And Trump just does it more publicly. So
in all caps, too.
In all caps. More importantly, the Supreme Court just kind of ruled on this. Trump fired 2 FTC commissioners a while back, and they were reviewing whether or not this particular carve-out called Humphrey's Executor would be upheld. It's a law from the 1930s where FDR tried to fire an FTC commissioner who then during the period when he was suing to get his job back actually died. So the lawsuit went on and the courts ruled like the president can't fire these independent commissioners. What's interesting about the lawsuit that just went to the Supreme Court is that the Supreme Court basically narrowed down their ruling saying, yes, the president can technically fire people that operate out of the executive branch, but the Fed is a quasi-unique institution that is kind of off limits. So you really can't fire Fed Chair Powell. And with all the talk and bluster, if Trump really had the power to do it, he would have done it by now. Mm-hmm. So it's a good story. To me, actually, it's a sign of failure on the fiscal front, because if you really, really wanted to peel back why he's talking about the rates, it's because he wants to refinance the debt and our debt burden, which, to be fair, it's enormous, right? We're getting to a point where like 30 cents on every dollar that we send to the government in taxes is being used to pay interest on the debt. That's crazy. Okay, so you have to resolve that. And so there's 2 ways to do that. You either cut spending and raise revenue, higher taxes.
Can't do that. Can't do either of those. Can't cut the spending. Can't do it.
As we've learned with this bill that's making its way through Congress, right? We're talking about trillions of dollars in new debts being added over the next 10 years. Deficits will go up. And so then the only thing to do then is get lower rates if you want to have a lower interest burden. And so to me, that's a sign actually of failure on the fiscal side, but also informative, because when has the stock market hated high deficits, right? Government deficits are private sector surpluses. So if the government wants to spend more money and Trump is going to call for lower rates and get a Fed chair that does it, like it or not, that's going to be inflationary for asset prices. So long stocks, I guess, could work.
Yeah, I mean, it's a story as long as time. It's been the last like 30 years of just
our lives.
Our lives, yes.
Yeah.
And it actually feels, Obama. This is not necessarily the one time, but this is the time where it's like, okay, if inflation is here and asset prices are rising, like this is really where it feels like if you're just sitting on cash, you are, you're not putting yourself in a position to offset these things that are affecting you negatively if you're just sitting on cash at this point. But I think it's also potential catalyst for Bitcoin prices, as Bitcoin prices have become more in line and correlated with NASDAQ and E-mini, so E-mini prices. So it's like, if this is the world we're living in where everything's going to be ripping higher, like, especially with low vol, we know low vol can tend to cluster over long periods of time. I think it's going to be, we might be in for a crazy couple of years here.
A party like it's 1998, 1999.
Yeah.
There you go. I know you gave us that chart porn earlier this morning, the 97 to 2001 analog.
It's holding up. I mean, we've shared that on air before, right? How the market was looking like it was behaving in 1998, where you get that big sell-off and sharp rebound. But July has just been such a good month for the past few years. Is this going to be? I know the contrarian and people say like, "Oh, are we going to go 11 years in a row where we're green?" I mean, even going back 20 years, the market's up 85% in the month of July because people who were wrong for the first half of the year really just got to put their chips down and try to play catch up. And I think that's very much the case still here. We talk about kicking the can down the road on tariffs. That's got to happen. And I say that's got to happen not because I'm, worried about the tariff impact itself. Let's set that aside. The administration's stated goal is to ring fence China, to decouple critical industries from China. We could go into a world because of the staggering of these deadlines where if the July deadline isn't pushed out, our allies and friends will have higher tariff rates than what we're applying to China, which incentivizes building more stuff in China. That's not going to happen, right? Come on. So we're going to get that can kicked down the road. That's a nice little positive catalyst coming down the pipeline. With that catalyst there, you get to August, September. Maybe there's some weakness as the market says, okay, when does the Fed cut? But the Fed looks like it's going to cut in September. There's no reason for it not to if inflation doesn't come about. I see a pretty boring summer here, which is ridiculous to say after we just bombed Iran 2 days ago. But the summer is going to look like, I think it's going to be pretty quiet.
You think the whole tariff thing down the line, like let's say, when is the China situation? Is that September? August. So you think around then we get another push / done with tariffs? Like, what do you think the probability is that the whole tariff thing just kind of gets ignored and we act like it never happened? Because I think that's relatively high.
I think that's going to be the catalyst for your typical summer swoon, right? August, September into early October. I'm Gentile, so forgive me. I think it's what Rosh Hashanah to Yom Kippur. I forget the holidays, but there's that window of like 3 or 4 weeks between the two Jewish holidays where the market tends to get really weak. So like that's a seasonal picture. So let's put that in one corner. Let's say Trump kicks out the tariffs for everyone else in July. The China tariffs come around in August. At that point in time, we're past the holiday ordering window. Okay, companies typically place their orders for holiday toys, knickknacks, gadgets 6 months out. So if those tariffs go into effect in April, May, when are people buying toys for their kids? October, November, December. So you're putting a kink in the supply chain right before the biggest consumption window of the year for American consumers. That could be hugely problematic. Of course, these tariffs are kicked out. So if Trump decides to levy them in August, will it have any impact on the inventories coming in for the holidays during peak consumption? It will not. So I think actually in terms of a negotiating tool, the August tariffs are more likely to be reinstated, if only for a short period of time. That's what I'd be looking for as a reason to be a little bit more demure at the end of the summer.
Yeah, there's a little bump in implied volatility. So July 9th is everyone else's end for the 90-day pause. China is August 12th. If you look at the July 9th implied volatility for SPX, there's a tiny little bump. But if you look at the August 8th, 2025, 45-day cycle, it jumps from the previous week of 240-ish or 190 all the way up to the mid 200s. So there's definitely a little bump in implied volatility for that week, which is interesting.
So it's not just a story, right? You can see people are beginning to price in that risk. Yeah. Something could happen at that juncture. I think that's worth watching. It's not just, this isn't just a quirk in the pricing right now. There's a legitimate event that rests right around that expiration, why the market's starting to behave like that.